first, let's look at debt securities that is classified as held to maturity. As we just mentioned, under this category, investor has the positive intent and ability to hold the security to maturity. And as for the financial reporting, they are usually reported on the balance sheet at amortized cost. And there's no need to calculate fair value or market value of the security because the investor has an intention to hold it to maturity. So the change in fair value doesn't matter here. And before we go into the details of the journal entry under this category, let's take one step back to look at what are debt securities. So debt security, that is basically bond or other debt security, they usually have four characteristics. The first characteristic is they should have a face amount, or it is also called face value or principal. Those are alternative names for it. And then secondly, they should have a maturity date. So a face amount or face value and a maturity date, when is it going to mature? And certainly it should have a stated interest rate or pattern of payment. So this stated interest rate, it is also called coupon rate. And then these three characteristics, they determine the amount and timing of future cash flows of the bond. And then they have a fourth characteristic, which is the market interest rate. And then we use this market interest rate to discount future cash flows. So the first three characteristics, they give us the amount and timing of future cash flows. And then we need the fourth one, the market interest rate, to do the discounting. And discounting future cash flow at the market interest rate at the point of bond issuance, that gives us the present value of the bond at issuance. And if this is a fair market, meaning that this bond is traded at the market at its fair value, then this should also be the purchase price of the bond. So, and if under the discounted future cash flow, that's true. So if the market interest rate, so the rate that we use for the discounting, if it is more than the stated interest rate, which is the coupon rate, we're going to get the price of the bond smaller than the principal, which is the face value of the bond. And then because the price is sold at a price that is smaller than its face value, so the bond is sold at discount. And if the market interest rate is smaller, so in the previous situation, if the market interest rate is higher than the stated interest rate, and then if the market interest rate is smaller than the stated interest rate or the coupon rate of the bond, the price is going to be higher than the principal or the face value of the bond. And then we call it the bond is sold at premium. And then, of course, the market interest rate is keep changing during the period. So even after the issuance of the bond, the market interest rate is going to keep changing. However, a held to maturity security, we don't need to mark it up or down to its fair value. So which means because the change in the market interest rate after the issuance of the bond, the fair value of it is also changing. But because we have an intention and the ability to hold the bond to maturity, so after the issuance, the change in fair value doesn't matter to us. So this is basically about debt securities. And then if a debt security it is classified as held to maturity, basically for the journal entry, we have three situations here. The first situation is what journal entry do we make when we sell the bond, when we purchase the bond. And then the second journal entry is how about when we receive the interest payment. And the third situation is what is the journal entry when we sell the bond. So first of all, what is journal entry when we purchase the bond? So when we're purchasing a bond, we're paying out cash. That's why we credit cash. And we get the bond. So getting the bond is an asset for us. That is a bond investment for us. That it should be recorded as investment on the firm's balance sheet. And then depending on whether this bond is purchased at premium or discount. Suppose here that we are purchasing the bond at a discount. So we debit investment in bond at its face value. And then because the bond is purchased at a discount, so the cash we are paying is smaller than its face value. So there will be an imbalance at the credit side. And this is recorded as discount on bond investment. And this is a contra account to the investment account. So the discount on bond investment is a contra account to the investment account. And in some other situation, if this bond it is purchased at a premium, the investment is going to be smaller than the cash paid. And then we need to debit premium upon the investment. And this premium on bond investment is going to add to your investment account. So all investments, those are initially recorded at cost, which is how much cash we are paying for this investment, which is also equal to the present value of the security at the point of purchase. So if this is a fair transaction, meaning that we're not we're not pointing a gun at your head for you to be engaging in this transaction with me, then the bond should be translated at its fair value, meaning that the price we're paying to get this bond should be equal to its present value of the bond at the time of purchase. And then all investments are initially recorded at cost, which is how much price we are paying, which is also equal to its present value at the time of purchase. So this is the first journal entry, the purchase of bond. And then the second journal entry is the journal entry. So after we have purchased the bond is, if it is not a zero coupon bond, then it should pay us coupon, which is paying us cash interest from time to time. And then what do we do when we receive this interest payment? So first of all, when we receive this interest payment, because we're receiving cash, so we debit cash. And then the cash interest we're receiving, it is calculated as the face amount or the face value of the bond multiplied by the stated interest rate, or it is also called the coupon rate, and multiplied by the fraction of the year. So if interest is paid out once a year, then this fraction of the year is 1. If it is paid out once half a year, the fraction is a half. So yeah, it's when so it's a half of like 0.5, 50%. And then if this interest is paying out every quarter, the fraction of the year is 1/4, so 25%. And then we need to record that this interest to us, that is interest revenue. However, interest revenue does not necessarily need to be equal to the cash interest we receive. The interest revenue is calculated as net book value of our bond investment multiplied by the market interest rate at issuance, and then multiplied by the fraction of the year. So if it is paid out quarterly, that is 1/4. And then if this bond is issued at a discount, the cash interest we receive is going to be smaller than the interest revenue you are going to calculate. The difference is going to record as a debit to the discount on bond investment. So if you recall previously, our discount on bond investment, that account, the balance is at the credit side. And then by debit discount on bond investment, it is going to decrease the balance of this account. And then in some other situation, the bond is going to be issued at a premium. So if it is issued at a premium, we're going to credit premium upon the investment. And then, so as I said here, the cash interest received, it is going to be calculated as fixed amount multiplied by stated interest rate, multiplied by the fraction of the year, versus interest revenue is going to be calculated as net book value multiplied by the market interest rate at issuance multiplied by the fraction of the year. And the difference is going to the discount on premium. So that is the second journal entry we're going to record if this bond investment, it is classified as held to maturity. And then the third situation is the third journal entry is for the sale of the bond. So sometimes the firm is going to record this bond until maturity, but sometimes they're going to sell it before the bond matures. So when we sell the bond, we're going to get cash. So we're going to debit cash. And then we're going to write off all of the value of the bond. So everything that is all of the accounts that relate to this bond. So we're going to write off investment in bond. And if the bond is issued at a discount, we're going to write off the discount account as well. And then depending on whether we are getting more or less than the net book value of the bond. If we're getting more than the net book value of the bond, we're going to record a gain on sale of the investment. And if we're getting less than the net book value of the bond at the time of the sale, we're going to debit loss on sale of investment. And then here, of course, if the bond is issued at a premium, we are going to credit premium upon the investment. And if we're getting a loss, we're going to debit loss on sale of the investment. So those are the three basic journal entries. And then here, before we go into look at the example, I just want to give you a reminder of, you may have learned the bond amortization table somewhere before, but here I just want to go through it before we go into the example, because this is the very basics. You are going to need those numbers when we make those journal entries. So the bond amortization table is basically, this is an amortization table. And then the fixed value of the bond, it is 1 million. So, okay, maybe let's look at the example first, and then I will explain those numbers. The example, if you go on Island, you are going to see an example. It is posted on Island. And the example is that Firm A purchased a 10-year bond with 1 million face value and 10% interest paid semi-annually. So the fraction of the year here is 1 second. The market rate for the similar bond is 12%. And then we know here the coupon rate or the stated interest rate is 10%. The market interest rate at the time of issuance is 12%. Company A paid 885,301 for the investment. So in other words, the present value of future payment and including principals and interest, it is 885,301. The fair value of the bond on June 30th, 2013 is 850,000. On July 1st, 2013, company sold the bond for 860,000 for its fair value at the date. What are the journal entries to record the purchase of the bond, the interest revenue, fair value adjustment, and sale of the bond? So before we go to the journal entries, let's go back to look at the amortization table. So here, the face value of the bond is 1 million. The carry amount, the book value is 885,301. So this is the present value of the bond. The face value and all of the interest payment discounted under the using 12%, the market interest rate at the time of issuance to the present. That will give you 885,301. And then the cash interest rate, this is calculated we take the face value of the bond, multiply by the stated interest rate, which is 10%, multiply by the fraction of the year, because the cash interest, it is paid out semi-annually. So once half a year. This is how you get 50,000. So once half a year, the company is going to get 50,000 cash interest payment. And this doesn't change. It is going to be paid out for 10 years. And then the effective interest rate, this is calculated by taking the book value of the bond. So the first half a year, the beginning book value is 885,301, and then multiply by the market interest rate at the time of issuance, which is 12%, multiply by 1 second, so 1/2. That is the fraction of the year, and you are going to get 83,118.06. So that is your first effective interest. And then these two numbers, unless your stated interest rate is equal to your market interest rate, otherwise these two numbers won't equal. So under this situation, our market interest rate is higher than the stated interest rate. And then our effective interest rate is going to be higher than your cash interest rate. So the difference is going to be 3,118. And this is going to this is going to kind of erase your discount this is going to amortize your discount account, or in other words, this is going to kind of erase your discount bond investment account. So, and then after this discount amortization, your discount is going to be decreased to 111,581. So after this discount amortization, the book value of the bond is, because your discount goes down. Discount is a contract account to your investment account. So our invest will go up. And then the second, and then after another half a year, the second time you calculate your effective interest rate, this number is going to go up because your net book value goes up. And then you repeat this process for 10 years. At the end, the carrying amount of your bond investment is going to be equal to your face value, which is 1 million. And then, so if you hold this bond until maturity, the carrying amount of the bond will be exactly equal to the face value of the bond. And then the last time when you receive the principal payment back, you are going to receive 1 million back. And then, so you are going to debit cash 1 million and credit your bond investment in bond, which will exactly equal to the face value of the bond at the time, which is also your net book value of the bond at the time. So you are going to be even. Your journal entry, there will be no imbalance at the debit or credit side if you retire the bond at its maturity. So now let's look at an example. Let's first look at the held to maturity situation. What is the journal entry if you purchase the bond? And what is the journal entry to record interest revenue? Is there any journal entry to adjust bond's book value to fair value? And how about when you sell the bond? Please take 10 minutes, try to write out the journal entry on your own, and you can pause your video for now. So the first journal entry, when you purchase the bond, you are paying out cash, which is 885,301, and you are getting the bond, and this bond is investment for you. So we debit investment in bond. At its face value. And this journal entry does not balance. The imbalance is at the credit side for 114,699. And this is recorded as discount on bond investment. So this is your first journal entry when you purchase the bond. What is your journal entry on June 30th, 2013? So we need to recognize interest revenue because we're receiving interest now. And the journal entry is to debit. So because we're receiving cash interest, we're debit cash. And the cash interest we're receiving, so the face value of the bond is 1 million. Multiplied by the stated interest rate, multiplied by the fraction of the year. So that's 50,000. So we're receiving cash interest of 50,000. And then we need to record it as interest revenue. The interest revenue is calculated as the book value of the bond at the time, multiplied by the market interest rate, multiplied by the fraction of the year. And we already calculated it here. So we just take the number here, this number, which is 53,118. And this journal entry doesn't balance. The imbalance is at the debit side for 3,118. And this is recorded as, so this is viewed as a reverse of our discount of bond investment account. So this is the second journal entry when we receive the interest payment. Do we need to adjust bonds fair value to book value at the end of June? The answer is no. We don't need any journal entry here because this is a held to maturity security. So we don't need to worry about the change in fair value. And on July 1st, we sold the bond. So when we sold the bond, we are getting cash. This bond is sold at 860,000. And we need to write off the bond from the firm's book. And if we look at what do we have on the firm's book regarding this bond, so it is, we have a face value of 1 million. And then this bond, the discount on bond investment after the first amortization, we still have a balance of 111,581. So we need to write this off as well. So we need to write off these two accounts. We credit investment in bond of 1 million and debit discount on bond investment of 111,581. And this journal entry is not going to be balanced. The imbalance is at the debit side of 28,419. And this is recorded, this is viewed as a loss on sale of investment. And if you look back at our amortization table, at the time of sale, this bond, the net book value of the bond is 888,419, but we're selling it at 860,000. So so by selling this bond, we're generating a loss on investment. We're selling it at less than the net book value of the bond at the time. So this is about held to maturity bond security. And then we're going to look at the trading security and available for sale.